Most investors spend their time chasing the same handful of stocks, the ones in the news, the ones all their friends are talking about, the ones popping up the most in social media. And yet they are often surprised by the very mediocre results. Here's the thing, by the time a stock is making headlines, the easy money is usually gone. So today, I'm going to go somewhere else entirely. We are flying under the radar to discover four stocks scoring highly in our quant rating system. These are tickers with genuine upside potential, in some cases double or more according to top-rated Wall Street analysts, and all of them have real business growth to back up all the hype. I'm Steve Reitmeister, partner at WallStreetZen and former editor-in-chief of Zacks.com. Our quant team analyzes 4,600 stocks every day through the lens of 115 different fundamental and technical factors to find the names with the highest probability of beating the market. And yes, today's four picks are the ones flashing some of the strongest signals. Before we get into them, please hit that like button. It tells the YouTube algorithm to push more videos like this into your feed. It takes you just a second. All right, quick note before we begin. Investing carries risk. Everything I share with you today is research and analysis, not personalized investing advice. Do your own due diligence and size positions according to your own risk tolerance. All right, let's get into everything with stock number one. We're talking about Indivior Pharmaceuticals. Hope I'm saying that right, with the symbol of INDV. The first pick could not be more timely. Indivior recently reported earnings, and the print was an absolute knockout. This is a specialty pharmaceutical company focused on addiction treatment. Their flagship product is a once-a-month injection used to treat opioid use disorder, and it's the only long-acting treatment of its kind on the market. Now, every month, a patient gets one shot instead of taking a pill every day. That unique delivery model is what's driving the entire growth story. Now, let's look at that most recent earnings report. Total revenue grew 19% year over year, with the flagship product alone up 32%, thanks to a record number of new patients. That 19% revenue growth translated into 134% earnings growth, which was nearly 50% above analyst expectations. This marks the eighth quarter in a row that the company has beaten our earnings estimates. On top of all that, management did the thing every investor wants to see, and they raised full-year guidance. INDV is a strong buy in our Zen rating system, ranking the top 1% of all 4,600 stocks we track. This is a well-rounded investment profile, scoring top 16% for value, top 12% for safety and financial strength, top 10% for growth, and top 4% for sentiment. Put together, this mix suggests the stock isn't just a speculative momentum play. It's showing the rare combination of strong fundamentals, earnings growth, strong institutional conviction, and relative stability all at the same time. Now, the real risk here is product concentration. Roughly three-quarters of revenue comes from the flagship product that I mentioned, and the entire specialty pharma sector is sitting under a cloud of the most favored nation pricing initiative. If pricing pressure ever lands on the company the way it has on some other names, then this bullish thesis likely falls apart. But all in all, the positives far outweigh the negatives at this time. It's a thriving specialty pharma company riding an 8-quarter beat streak, leading them to raise guidance once again. Plus, it scores in the top 1% of all stocks in the Zen Ratings model, which points to likely outperformance in the months ahead. The next pick is very different. 165-year-old business that you've seen quite a few times in your life. Oddly, it's down significantly from its highs, but with a potential turnaround on the horizon. That brings us to stock number two in the Brinks company with the symbol of BCO. Brinks runs the armored trucks that move cash, valuables, and secure cargo for banks, retailers, governments, and central banks around the world. They've also expanded into ATM management, cash management for merchants, and digital security services. Traditionally, a boring yet durable business, but right now it provides an interesting investment setup. That's because the stock is down roughly 20% from its 52-week high set in February. That pullback came on the heels of broader market jitters, not really anything specific to Brinks itself, which spells opportunity. Now let's look at what the data tells us. Last year, revenue grew only 5%. Now, I know what you're thinking. That's kind of boring. But that 5% revenue bump translated into 28% earnings growth. That's the type of strong operating leverage you generally want to see when looking at a mature cash-generating business like this one. Looking forward, earnings are projected to grow 53% per year, more than triple the industry average. And given the recent drop in the price, the PEG ratio looks pretty darn cheap at just 0.48. Again, anything under 1.0 for the PEG ratio is a rare value in today's market. Among the Wall Street analysts we track, BCO has a consensus strong buy rating. Even more enticing is the average target price, suggesting 43% upside from current levels. But some are even more optimistic. Truist Securities analyst Toby Summer, ranked the top 13% of all analysts for his stock picking prowess, has a price target that suggests over 50% potential upside in the year ahead. Now, BCO is also a strong buy in our Zen rating system, ranking the top 1% of all stocks we track. The component grades are where it gets even more interesting. Top 18% for financials, top 10% for value, and top 4% for both safety and growth. That top showing for growth and safety at the same time is rare. It suggests that it's a high growth name without the normal amount of risk that comes with that. Or to put it another way, there's not that much risk given the ample reward potential of these shares. There are some considerations you should know. For example, momentum scores a very modest D, which isn't exactly a surprise given that it's pulled back 20% from its highs. But once again, when all is said and done, the overall thesis is still very impressive with ample Wall Street support, along with the Zen ratings for value, safety, and growth. Okay, before we move on, do me a favor and hit the subscribe button and notification bell. We post analysis like this every week, and you'll see the picks before the rest of the market catches on. All right, let's get back to those top stocks. The next pick takes us out of armored trucks into a completely different kind of security, one that over 1,000 government agencies are paying for right now, and yet most retail investors have never even heard of. I'm talking about stock number 3 in Cognyte software with the symbol of CGNT. The company makes investigative analytics software for law enforcement, intelligence agencies, and corporate security teams. Their platform takes massive volumes of communications, financial and surveillance data, and then finds the patterns that really matter. Over 1,000 government and enterprise customers around the world use it to track fraud rings, surface security threats, and run investigations. To understand why it's on our stock list today, all you have to do is look at the tremendous earnings trajectory. Cognyte has now beaten EPS estimates 5 quarters in a row. The most recent quarter saw earnings soar 233% year over year. The company has gone from posting consistent losses 2 years ago to consistent profitability today. This is the very definition of earnings momentum at play. Wall Street coverage is generally thin, with just one analyst issuing a strong buy rating. This is actually a positive for early investors because a company growing like this will sooner or later get more strong buy coverage. Each time that happens would be another catalyst for shares to push higher. Not surprising, the Zen Ratings is picking up on this special investment story, earning a strong buy rating in the top 4% of all stocks we track. As we drill down into the component grades, it scores well in several areas, in top 10% for growth, top 2% for safety, and top 1% for sentiment. That last part means the smart money is already circling around this stock. That's an exceptionally strong mix because it suggests the stock has institutional conviction behind it, unusually strong growth potential, and favorable signals from the AI-driven predictive model all at the same time. Now, what's not to like about that? And by the way, if you want one fresh pick straight from the Zen rating system every Monday, then claim your free copy of our Stock of the Week newsletter. That's where we blend the power of our quant model with my greater than 40 years of investing experience to deliver one high conviction stock every week. I'll drop the link in the description below, or you can just scan the QR code. Our last stock today is the one with the most upside potential on the entire list. In fact, Wall Street price targets on this name go more than 250% above where it trades today. Got your attention? Well, that brings us to our fourth and final stock with BioCryst Pharmaceuticals with a symbol of BCRX. BioCryst is a biotech name focused on rare diseases. Their commercial business is anchored by an oral therapy for a serious, life-threatening genetic condition that causes severe, unpredictable swelling attacks. Before BioCryst drug, every treatment for this condition was an injection. They built the first daily pill, and it's been changing the patients' lives since approval. Patients take it, the company collects high-margin recurring revenue, and the addressable market keeps expanding as more patients get diagnosed. Now, in 2025, BioCryst posted its first full year of profitability. In fact, profits from the core business were up a record 198% year over year. In December, the FDA approved a new pediatric formula for kids aged 2 to 12. It's the first and only oral preventative therapy for this disease in that age group, opening up an entirely new growth opportunity. After that, in January, BioCryst closed an acquisition that brought a second drug into the company. It's a long-lasting injectable for the same disease, currently in late-stage clinical trials with FDA submission expected for the the end of 2027. So this is no longer a one-product company. It's now a rare disease franchise with a profitable drug in the market today, funding a second drug likely coming online next year. This is where it gets really interesting. The street average price target implies upside of 116% in the year ahead. However, two top-ranked analysts see shares pushing even higher. Jonathan Willebon of Citizens predicts 178% upside for shares, while Andrew Fine at H.C. Wainwright is pounding the table for 256% upside in the year ahead. The Zen rating is on the same page as these top analysts. Across all 115 factors we analyzed, the stock scores in the top 2%. Their top 17% showing for growth is nice, but what really stands out is the top 2% score for value and top 1% for financial strength. This is a tantalizing combination of growth and value that makes for a compelling investment setup. The real risk on BioCryst is that it's a single product dependency. Despite the recent acquisition, the flagship drug is essentially the entire commercial business until that second drug wins approval, which won't be before 2027 at the earliest. Any clinical, competitive, or pricing pressure on that flagship drug directly harms this investment thesis. But those risks may be worth it for this newly profitable rare disease company with an expanding franchise, a phase 3 pipeline asset, and top-tier analysts targeting more than 250% potential upside from current prices. There you have it, 4 under-the-radar stocks, each with impressive growth, strong analyst conviction, and a seal of approval from the Zen Ratings model. Now I want to hear from you. Which of the 4 stocks is your favorite, and why? Or maybe there are other hidden gems that you think I should cover in future videos. Please share it all in the comments section below. And if you want more good investment ideas, then here's something you'll enjoy. I recently did a video on 4 AI defense stocks that our insiders are loading up on. That video is popping up on your screen right now, so go check it out.